Today, we're going to be talking about scaling into positions. How do we do it? What's the good way to do it? What's the bad way to do it? And so before we get into that, I just want to give you an example of this before we move in. So according to my system, if you don't know the way that I trade, basically I have a fundamental bias, right? So I go through essentially a professional grade process to pick a list of stocks that are likely to go up and are likely to go down over that week. Normally that list has about 20 to 30 stocks on that list. And by the way, you're more than welcome to check out those because I share them with my Inside Alpha members in the description box below if you want to check it out. If you don't, it's fine. I'll break it down for you very, very briefly in this video as well. But essentially, I had a daily confirmation right here. And the way that I like to do things with scalings is I have an overall time frame that my bias works on. So I know that it's about a 1 to 3 month period. Doesn't mean that my trades have to last that long. It's just how long these fundamentals tend to have an effect. And then basically at that point, once I've got the daily confirming, that's my sign that the overall flow is beginning to move. At that point, only from then do I allow for confirmation on lower time frames, whether that be a scale in or whether that be just me missing the original position for whatever reason, I was away or whatever. And then I can just use those subsequent entries. So I'll tell you what that looks like for me. So it's really, really simple. The daily confirmation is my overall momentum that aligns with my bias. This tells me, look, is this stock now aligning with the bias that I had already analyzed for this? Once I've got that, then I move down to the 1 hour. So if we actually just look at the, so this would have been here. So from this point, now on the 1 hour time frame, I can look for the same confirmations again. And then I literally just rinse and repeat over and over and over again. But the problem is that when you actually go into the world of scaling in, you can actually end up destroying an edge just as much as you can end up maximizing it. And the reason is simple. If you look at a kind of textbook understanding of how prices tend to look in an uptrend, it's like this. And as a trend trader, which I am, there are typically only two ways that trend traders get involved. And people will wrap it up and they'll have their own neat bow tie and special name for their magic system or whatever and be like, oh, I only trade liquidity, or what it's like. You know, but at the end of the day, they all fall into these categories. Number one is a breakout system. So that would be, if I just get the tool up, that would be getting involved something like that on the break of highs if we're going up. And then the second option, which is more aligned with what I do, is trying to essentially catch this turnaround point in the pullback. Now, one thing that you'll notice as a general rule of thumb is that the pullback traders tend to have slightly worse win rates. Why is that? And why is that important to scaling in? Because scaling in is all about risk, right? It's all about risk structures and knowing really how to manage things correctly. Because the whole purpose of scaling in is to maximize our exposure to a potentially larger position and basically align with that, you know, the golden rule of trading, which is I need to make more when I win than when I lose. Now, just as a side note, that doesn't mean that you have to have a giant risk reward. It just means that overall, however you structure it, you need to make sure that overall, obviously, you're winning more than you're losing. But to give you an example of this and why this is the way that it is, if we were to just zoom in on this little pocket of time over here, in reality, this is going to look different every single time. But there may be scenarios where, you know, you're going up. I don't know why it keeps getting rid of that, but where you get a buy signal here, but then we go down, buy signal here, but then we go down, buy signal here, but then we go down, and then we have the move. And if you're someone who's a pullback trader, which, you know, most people typically are, often they'll hug the low like this, you know, something like that would be quite normal for them. And then they'll rinse and repeat this at every single position. So they'll get stopped out, they'll enter again, stopped out, enter again, and then eventually they'll have the winning position down there. Now, of course, if you've lost 3 or 4 times, then you need to, as a bare minimum, have a 1 to probably 4 risk reward, excluding costs, in order just for you to break even. Now, that's fine. That can be factored into risk management systems. It's not a problem at all. However, you have to understand the type of trader that you are. And this, whenever you have a larger risk reward system, you are guaranteeing that your win rate is going to be lower. And that's fine. But psychologically, not everybody is cut out for that. Not everybody wants that. And that's understandable as well. But why am I telling you all of this? Because it's very important when we understand our risk structure, how much we're risking per idea. Now, this has got lots of different names in the trading space, but for me, I don't really give it a specific name. I just call it the idea risk bucket. Okay, now all this means is it means how much am I willing to risk on this overall idea in this particular segment. So if we go through this example here, let's just say that I only ever wanted to risk 1% on a total idea. That would be pretty low. Normally for me, it's between 2 and 5%. And I'll go into more detail on that in a minute on why I pick those and how I decide which one of those is going to be. But let's just say I only wanted to risk 1% overall. And I risked 1% on this first position here. Well, it would have been stopped out. And so I wouldn't have any more risk to apply down here because I'd already maxed out my overall rule. So you might say, okay, well, I'll risk 1%, but then I'll allow for maybe 4%. So it's 1% each. So 1%, 1%, 1%, 1%. Okay, but then technically your actual risk for that idea is 4%. So if that's different to how you should have structured things, you didn't think of that ahead of time, that's going to be a big influence on your actual P&L long term. And so what does this mean? Well, it means that for me, because this will all circle back to scalings, it's very important because you can destroy an edge by doing this wrong. Because for example, let's just say that I had a 3% max like idea risk, so the amount I'm willing to risk, and I lost 1, 2, 3 times. That means that by my own rules, so my own choice, I've said, look, I've made a rule now that has meant that I can't trade this anymore. And then we have the big move. So I've just taken 3 losses basically for no reason. Now, are there times where this is going to happen regardless? Yes. Even if you have the most sophisticated rules in the world, there will always be times where your rules weren't quite good enough. You've taken losses, you just have to cut your losses, and then it will run without you. So this is what I mean about needing to be a little bit more dynamic about how we do things. And so the way that I like to structure this is I like to say 2 to 3 tries per idea before I wait for something new. And in a lot of cases, I will just abandon it after 2 or 3. And so what that means is it means that I'm normally not hugging the low like this. I normally give it some breathing room. I'll also be a little bit more conservative. If I've already taken a loss, I'll normally wait for a little bit more because it forces me to think to myself, okay, I know that I've only got this amount that I will risk. I will only ever risk that amount. So before I start trying to stack in and add more and do all this sort of stuff, I want to have even more confirmation in my direction. And I'll go into more detail on what that is in a minute. And so that, by the way, waiting for something new could just be me being patient, could be me waiting for multiple false moves, waiting for a very significant move that almost looks like I've missed some of it, and then transitioning to that. That can be the case sometimes. It can also be me going down to a lower time frame and trying to capitalize on these smaller little swings within here. If I'm waiting for daily confirmation, then that could be the 1 hour, like I showed you in the beginning. So this is a position that I'm in right now. This is at break even at the moment. We have the daily confirmation over here. So this is my signal that things have aligned with my overall fundamental idea. And then from that point, I can then scale in on the 1 hour time frame. Now in this case, I didn't actually enter on the daily because I'd missed this in full transparency. But I then was like, okay, well, I've missed that. Let me then scale in on the 1 hour. But it would be the exact same process. In other words, the scaling process, entry process is the exact same for me as it is for if I've missed the overall swing move and I'm just looking to kind of get involved a little bit later. It's the exact same process all in all, but it's also an important process because it allows for that extra confirmation. Like if I had missed this daily, which I did in this case, right? I'd miss that move. Then the next question that anyone asks is, okay, well, where's that next place I can get involved? And the answer is the same as how do you scale in? And we'll get onto this as we go through this. But just to kind of circle back here and to be clear, I said 2 to 5% is what I will allocate to a particular idea. Now that's dependent on 3 things. The first one is going to be how my account is going. So this is a personal thing. This is going to change from person to person and from time to time. All it means is it means that if I'm on a losing streak, I'm going to be edging towards risking less per idea because I don't want my drawdowns to compound. Similarly, if things are going really, really well, I'm going to be more open to moving up the percentage risk terms. The second one is going to be story strength. So people will often ask me, why can't I just trade technical only or things like this? And you can, like, there's nothing wrong. I traded technical only for a long time, but the reason that I switched over to adding a fundamental sleeve to what I was doing is because if you don't understand how strong the story is, which you can't just by looking at technicals because it only tells you the past, then how are you supposed to have any more confidence in one thing over another? You can't. And if you think that you can, 9 times out of 10, it's delusion, not anything else. And so understanding the story strength for me and kind of quantifying it gives a little bit more of a weight behind, okay, I'm going to choose to maybe risk slightly more here on this idea than I would have done before. Um, The third thing is then going to be correlation. So this is particularly relevant with stocks. For example, I'm not going to be over, like if I'm already buying one company, let's just say in the energy sector, then I'm going to be very cautious about buying another company in the energy sector as well, because it introduces too much sector risk. I'm overly exposed to one particular sector at one time. Now, for me personally, I don't want to do that, because it means if the entire sector collapses or has a massive down period, then both of my positions are going to be affected pretty similarly, which means that I'm doubly exposed to the same risk that I haven't been modeling, right? So correlation is another one. There are some other things in there as well, but these are kind of the big three main buckets for me. Now, when you're allocating these ideas, it also means that you could screw yourself, as I mentioned with this. And so a few simple solutions. Number one is just to widen the stop. This looks like an extreme thing. It's like, oh my God, my stop is so much wider. Like, how does this make any sense? Like, this is going to screw me over. The biggest thing that this actually changes, like in reality, is the win rate. Yes, you have to stomach more drawdown, but the win rate is actually a lot higher this way, and some people actually are just better at trading that way. It doesn't mean you have to sacrifice a good risk reward. It just means that you're not going for like 1-7s, 1-8s anymore. You're going to like 1-2 or something like that. That's still very doable, but again, it depends on the type of trader you are. It also means that the actual amount that you are risking can be different, because, for example, if we're here and let's just say we had that, 4% is our max idea bucket, right? Things are going pretty well. You're pretty confident in the stories. You're risking 4% overall. And so that means that per position, you were risking, let's just say 1%, because you were anticipating that your first position wasn't necessarily going to be right. So let's just say you risk 1%. And instead of, so 1%, and so instead of this happening down here, what actually happens is your first position goes straight into profit and things go up. Great. But your overall willingness was to actually risk 4%, but you only ended up risking 1%. So how does that work? Well, if you only ended up risking 1%, then you actually only risked a quarter of it. And so if you then compare that to someone that risked all of the 4%, but had a much wider stop, in that scenario, even though it looks like you had a better risk reward, the actual payoff is the same. Now, of course, there are nuances to that, and it does vary a bit. But the point is that if you've got a wider stop, you're accepting you're going to be wrong more because you've got a bigger stop loss and therefore a better win rate. You are able to risk closer to what your overall risk bucket has allowed for, which means that the actual value of each move is higher. So often they can cancel each other out and actually be very similar, depending again on how you structure it. It's a whole other topic. And so how do we translate this to actually scaling in? It's the same sort of thing, right? All it means is with scale-ins, it's all about understanding, okay, well, if I did opt for this approach, I was in a 1%, am I doomed to just stay at 1%? How do I begin to increase things up? For me, I have a way of scaling in that for me works nicely, which is very simple. If we're going up like this, when I'm scaling in, if I was to enter a position here, so this, let's just say this is my first position, and things are going well, so I get involved again. Maybe you get involved over here, for example, something like this. And let's just say I was risking 1% on each of these. The problem is that if I keep doing this and just keep adding on, let's just say I didn't move my stops to break even, just it will make for a better example. And then suddenly overnight, something comes out I couldn't have predicted, and then it goes all the way back down there and then begins going up again, and I miss this. In that scenario, I have basically lost 3 times the amount that I said that I would risk on the idea for nothing. And so when I'm scaling in, the biggest thing I'm actually thinking about is not making more. It's actually doing it in a way where I don't risk anymore. So I don't want to actually risk losing any more money. I just want things to be pure upside, essentially. How do I do that? So the first thing to note, similarly to what we said before, is the risk bucket on the table. So once you know your risk bucket, let's just say for the sake of argument, it's 2% here. So overall 2%. And we risked 1% on this position down here. By the time we get to this second position, if we've moved this stop to break even, we still actually have all of this to allocate again. Why? Because if we can risk 2% overall, and if we've already moved the stops of the first position to break even, that means that this first position has no risk anymore, which means that technically I can add on 2% risk on this second position. So that means that in terms of the size of my position, yes, I'm exposed by about 3%, but in terms of what I'm actually risking, it's still only 2%. And so similarly, if I get all the way up here, and I move my stop to break even again, I can add this third position on at 2% risk as well. Now, let's go through a slightly different scenario so that we can see how this plays out. If this then stops out here, then we've actually just made minus 2% that's actually been closed. That means that we've actually lost the maximum amount that we were willing to lose on this idea, but we are already still in two positions, which means that if we then continue to go higher, I wouldn't continue to scale in until no, I just wouldn't continue to scale in because we'd already maxed out the amount here. The only time I will ever break this is if a new fundamental story comes out that justifies it as a brand new stream. And that's basically when the idea itself becomes different. And this is why I always say that this is an amount I attribute to an idea and not to the actual trade itself, not to the individual technicals. You can't answer that with only technicals. You just can't. And so that's something to keep in mind. And so obviously there's also the other scenario where we come down and it stops us both at a break even. But even in that scenario, you still only have lost what you said that you would lose to that idea, right? That's the kind of general idea behind it. And so the long and short of it with scaling in terms of how I actually do it in terms of confirmation, it's really simple. Let's just say these overall swings are daily swings. I then just use the 1 hour, or you could use the 4 hour, just to trade those kind of more I don't want to say intraday, but I guess kind of intraday moves within there. It's the same thing. If you're a day trader, you're a scalper, that's great. You just need to wait for things to align. So I'll explain what I mean. On the left-hand side here, I'm going to draw the equivalent of, let's just say, a daily trend. This is going to be the daily chart. If we were to zoom in right on this section over here, this is where the daily goes from short-term bearish and then aligns with our overall direction. But as we go down, if we were to zoom in on this little bit, what does it look like? Well, it would look like a mini downtrend flipping to an uptrend like this. And so let's just say that this is the 1 hour. So people who are trading intraday or people who are even scalping or doing any of this sort of thing, I'm not necessarily actually against those at all. What I am in favor of, though, is just making sure it's done intelligently. And for me, the best way to do that is to wait for confirmation within confirmation. So in the same way that we took a pullback here and watched it change from pullback phase to push phase, similarly, once we've had that change in direction, we could have zoomed in on this little chunk, which is the exact same thing. If you think about it, it's a pullback transitioning to a push. And then we could zoom into that on a lower time frame. I don't know, let's just say the 15-minute. That's the next standard time frame I go down. Right, and then that's going to look its own sort of way. Then within that period, it's going to look, like it's going up and then maybe going down a little bit and then going back up again. And so this is essentially the process of how you can go down the time frames and refine your entry if you want. But the whole system here is like a domino. It's like I don't look at the 1 hour until we've had that daily confirming. Don't look at the 15-minute until we've had that 1 hour confirming. And if that's not clear how that's confirmed, it's because we broke here and we've changed and we've moved back up. I also have a more systematic way using the RSI. I've got a video for that. I'll link that in the description box below. And then we go to the 15-minute and then it's the exact same thing again. And in theory, you could wait for confirmation, then go down to the 1 minute. But you've got to keep in mind the lower down you go here. So the more you go from daily to 4 hour, 1 hour, so it's 1 hour, 1 hour to 15-minute, 15-minute to the 1 minute, the more losses you will take. Why? Because the more accurate you try to be, ironically, the less accurate you will be. The benefit of doing something like that is when you do catch the moves, you'll have some absolutely monstrous risk rewards. Like there are times where you'll have like 1 to 200 risk rewards, crazy, crazy risk rewards. But you have to take so many losses, so many break evens to be able to do that. That's the price of that type of a system. And whilst it's really great to fantasize about that, you need to ask yourself, are you honestly the type of person that can sit through all of that? Loss, break even, loss, loss, break even, loss. Not to mention the fact that in order to account for those increased losses, you need to risk much, much less per trade. It's the same reason why if you have a 80% win rate strategy with, let's just say, a 1-to-1 risk reward, you can risk much more on that than you can with a 1 to 20 risk reward with a 5% win rate, right? That because the probability of you hitting bigger and bigger losing streaks is exponentially higher. Therefore, you can't risk the same amount per trade because you've got basically a guaranteed chance of you blowing the account. So it's really something to keep in mind. And so when we're looking at this in terms of how I scale in, my favorite two places to start are the daily is my main, the 1 hour is my second. The 15-minute I will allow for sometimes, but most of the time I won't. Why? I don't want to. I don't want to stare at charts all day. Those times in my life are gone. And as you trade more, I'm sure you will get to the same point, right? You want to live your life, you want to do other things, maybe you've got a job, whatever it is, you need to keep things simple. And most traders end up finding themselves going there anyway. But you may be different, and that's fine. Again, I'm just talking about my experiences, and hopefully you can take the pieces that apply to you best that you can. And so this is the main way that I scale in, right? I just keep it really simple, but it works on a domino system. I will not look at the 15-minute willy-nilly because my bias says that I'm bullish and therefore I'm just looking for 15-minute turnarounds. No, it has to start on the daily, then the 1 hour, and then the 15-minute if I see fit. But for the most amount of time, I'm focusing on the daily and the 1 hour. Because it's simpler for me, less losses, less frequently needing to look at the chart. And honestly, I've never found a crazy difference with the P&L difference anyway, at least not one that I'm worth paying the price for. I don't want to take all those extra losses. It's just not for me. And so this is the main way that I do things. In terms of the actual stories themselves, how I build the stories are built of a few different buckets. I will make a whole video on this, but the general gist is I break things down into analysts. So these are professional analysts. You've got to be very careful because not all analysts, this isn't about like having a favorite analyst you like. It's about looking at a collection of analysts who are forced to share with you what they're doing, who work at kind of big institutions and things like this. So it would be analysts. And the reason analysts is because they're forward looking, they're doing a lot of the work for you. So it's a high leverage data point to look at. Next one is going to be the growth, the profitability of the company, and going to be the momentum. These are the big four categories in terms of the actual stock level that I'm looking at. And again, if you want me to if you just want to see me doing this every single week, basically done for you, then feel free to join Inside Alpha in the description box below. About, like I said, 20 to 30 stocks in there every single week that I'm watching. I'll also share the exact entry methods I'm looking at and show you when those things are nearly setting up, etc., so that you can learn as well. But yeah, so this is the stock side. So I'll represent that with an S. Next element is the market element. So the market element is really important with stocks because a lot of stocks have a high level of correlation to the overall market itself. If the S&P 500 is going up, the stocks within it are likely going up as well, on average. That's why the S&P is going up, obviously. And so what that means is it means that I need to understand, like, okay, what are the factors driving the overall market? And there's two main things: growth and liquidity. Now, this is not me talking about like smart money concept liquidity. Oh, we raided highs and now, sellers are now stepping in and we can sell it off. Like, that's not what I'm talking about. I'm not shitting on those ideas because some of those ideas are actually quite useful for entries, but for actually timing, creating trade ideas, they just fall so unbelievably short that it's just not worth mentioning. These are fundamental drivers of what moves the market, right? The overall market. And it's obviously it's more complicated than this, but this just gives you a general gist. And there is also another layer, but that other layer is the sector level. So we have market, sector, stock, because within the market is made up of sectors is made up of stocks. And the sector analysis is really dependent. I'll use a couple of leading indicators for that to get a kind of an idea about what may be beginning to happen in the market, in the particular sectors over the next few months. Like, our industry is doing really, really well and the data hasn't picked up on it yet, these sorts of things. But the reason I don't talk about these things more on this channel is because whenever I do talk about them, no one seems to want to hear about them. That's the honest truth. And so I'm happy to make videos about these sorts of things, but I understand that everybody wants things, relatively easy these days. Like, I get it. And then it's not as sexy as me telling you, oh, look, draw a line on a chart and you're going to be a millionaire, And if you look online, the people who are pretty much always the most popular are people that will tell you exactly that. But yeah, I'd much prefer just to be honest with you guys, rather than try and desperately chase, viewers selling you a load of rubbish. So this is how I do it. It's a 3-step system. Most of the work is done in these two here, right? The market and the actual individual stock elements as well. I have a process to turn this into an actual number, which I again share with the Inside Alpha members, which just makes it really easy, because I'm sure that most of you are probably most interested in just timing the market, just doing the technicals and all that sort of stuff. And that's why I made Inside Alpha, because it's like, you don't have to worry about the fundamental stuff. I do that, and then just worry about the timing of it, which again I also teach in there as well. But whatever your process is, right? If it's this, if it's something else, the most important thing is to have a plan, have a structured risk management plan, follow it, and be very, 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 very diligent and very careful. So hopefully that makes sense. Hope you have enjoyed. If you have, I'd appreciate you leaving a like, and I'll leave a link to a video on the screen right now, which will go into detail on the actual entry criteria that I am using myself. So hope you enjoy, and I'll see you there.